Oh, okay, Bank of San Francisco. You guys are good friends of the virtual bank conference. We're really glad that you're here. Thank you. So BSFO is a Metro San Francisco bank with niches in business banking and nonprofit organizations. And we'd like to welcome Wendy Ross, right there, president, and Ed Obuchowski, CEO. Both are founders of the bank. And joining them is their CFO and head of commercial lending, which Wendy, I'll let you introduce. So go right ahead. Let me know if I can help with the slides, or Jennifer, if you've got them. Or
I think
actually,
we've got that covered. Thanks so much,
Julianne.
Oh, hold on one second. Let's make sure we have Leslie here. I apologize. Yes, I'm sorry. Okay, so Leslie's going to share the slides, right?
Yes.
Okay, Ian, can we make Leslie a do you I think Leslie, can you try to share your slides? There we go. Okay, great.
Okay, Julianne, we'll just get started.
Can you hear us okay, everybody?
We can go right ahead.
Right.
Thank you.
Perfect.
Oh, okay. Thank you, Julianne. And hello, everyone. As Julianne mentioned, I'm Wendy Ross. And first, we just want to say how very pleased we are to be with you all today. So special thanks to Julianne and Ian for that. Joining Ed and me today are Jennifer Kaur, our CFO, and Felix Miranda, head of commercial banking. Today, we very much look forward to sharing with you the Bank of San Francisco story and to provide an update on the performance of our bank, as well as a few of the key ways we are differentiating ourselves in the market, especially related to deposits. Before we get started, I'd like to direct you to our forward-looking statements and non-GAAP disclosures.
Leslie, are you able to? There we go.
Okay. Okay, and our next slide highlights the topics that we'll be covering today. So I just wanted to give a little background. Ed and I are two of the 11 founding employees of our bank, which we started in 2005. And it's interesting that we were the first bank to open in San Francisco in almost 20 years. Two banks, Presidio Bank and New Resource Bank, opened within a couple of years of our founding, but have since been acquired. So at this point, we're in the unique position of being the only broadly owned community bank headquartered in San Francisco and serving clients throughout the greater Bay Area. When we started the bank, Capital Bancorp, headquartered in Lansing, Michigan, was our majority shareholder. Some of you may remember Capital Bancorp and the significant financial pressure it was under during the Great Recession. To give you an idea of our team's determination and of our bank's culture, we were one of only 3 of the approximately 64 Capital Bancorp banks that succeeded in buying out its 51% ownership interest in our bank. And we accomplished that in 2010, a time when you probably remember banks weren't all that popular. This was a true grassroots effort, with the investors being our employees, directors, many of our clients, as well as other family members and friends of the bank. Fast forwarding today, to the best of our knowledge, we have 5 institutional investors who together own approximately 36% of our bank. Our employees and directors own approximately 17%. And I just want to mention that Ed and his wife are actually the largest individual shareholders, and my husband and I are within the top 10. So with this kind of personal financial commitment, you can see that our interests are aligned with those of all of our shareholders. Since the start of our bank, we've been believers in investing in technology instead of in an extensive branch network. And with that strategy, we offer our clients robust online and digital banking solutions for their day-to-day banking needs, coupled with highly experienced relationship managers who are available to them 24/7. Our only full branch is in our San Francisco head office, but we do maintain a loan production office in Walnut Creek, which is about 25 miles east of San Francisco and a key geographical market for us. As a community bank, we have very broad industry representation in our client base with no significant concentrations. Our clients include small businesses, professional service firms, contractors, fiduciaries, medical and dental practices, nonprofits, municipalities, families, and individuals. We don't bank crypto, cannabis, or money services businesses. I want to point out that one of the absolute key strengths of our bank is our executive team. Over the past several years, we've made a concerted effort to develop the next generation of leaders. Almost all of our leadership team received excellent technical training at major money center banks where they worked in the early years of their careers. Then in joining and working at our bank, they've meshed those strong technical skills with the culture and values of a traditional community bank. Jennifer Kaur, our CFO, who will be presenting next, is the one exception to the rest of the teams having been career bankers. Jennifer was actually an audit partner at the CPA firm BDO prior to joining us in 2019. During her career in public accounting, Jennifer worked both with some of the largest and the smallest banks in the US and worked with those banks in both booming and challenging economic times. With her experience in public accounting, Jennifer has brought a very helpful perspective and area of expertise to our team. You'll hear more on our financials from Jennifer, but quickly you'll see from the next 3 slides that our assets were $591 million as of the end of 2022. You'll note that our loans and total assets grew substantially in 2020 due to our very active involvement in the Paycheck Protection Program. We actually originated 929 PPP loans totaling $259 million. And that was an extremely high level for a bank of our size and reflected our team's strong commitment to helping our community at a pretty dire time for so many. I want to point out that our heavy involvement with PPP loans also led to a spike in our profitability in 2021 and to a number of significant long-term client relationships that we would not have had it not been for our team stepping up to help those clients with their PPP loans. Now I'd like to turn the presentation over to Jennifer, who will go over financial highlights and liquidity. Jennifer?
Thank you, Wendy. I would like to remind everyone that the press release highlighting our year-end 2022 financial results is posted on our website under the Investor Relations tab, as well as on our OTC Markets profile page. As a lot has happened in the last few weeks in the banking industry, I will comment on just a few year-end results and focus on some hot topics in the current environment, such as liquidity and interest rate risk. As Wendy noted, we had a large number of PPP loans in 2020, as previously noted in our 2020 and 2021 various press releases. However, you can see the growth of our non-PPP loan activity has continued at 13% in 2022. We decreased our broker and public funds at year end by $17 million from the prior year. And I will touch on the liquidity in March shortly. Relationship deposits remained relatively flat with a small decrease of $3 million. Net income decreased from the prior year, primarily related to the allowance for loan loss provision recorded in 2022. The loan losses were related to 2 unsecured commercial and industrial loans totaling $3.9 million. The loans were made to 2 companies in the real estate residential services industry, and both were guaranteed by the same individual, with the companies and guarantor having strained cash flows, primarily related to the extreme downturn in the industry. And after exhausting possible resources of repayment, we decided to charge off the 2 loans. Prior to these 2 isolated charge-offs, our cumulative net loan losses since our 2005 founding were under 750,000. As you can see in this slide, we have continuously grown our non-PPP interest income every year. In 2021, we had PPP interest income of 5.6 million, which decreased to 1.4 million in 2022, or a 3.2 million decrease in PPP interest income. However, our non-PPP interest income increased by 4.4 million, replacing the non-recurring PPP interest income from the prior year. The combination of loan growth, the rising interest rate environment resulting in the resetting of variable rate loans, increased our non-PPP interest income. Our diluted earnings per share have steadily increased over the years, with 2021 standing out from large PPP activity and no loan loss provisioning during that year. There has been great uncertainty in the banking industry over the past few weeks, so I'd like to highlight our conservative approach and liquidity position as of March 16th. As noted in the overview, we do not hold an investment portfolio. As such, we have not been impacted by the decreasing values on investment portfolios some banks have incurred. Additionally, we hold a minimum of 10% of on-balance sheet cash and have borrowing lines available totaling more than 200 million. Our unsecured or uncollateralized relationship deposit balance over the FDIC limit is approximately 38% of our total deposit balance as of February 28th, 2023. In addition, our total deposits and liquidity have modestly increased in March. We have historically taken a conservative approach to our balance sheet management, and while we would have reached for yield in prior years when there was an excess of liquidity, we decided to stay true to our core banking fundamentals on managing balance sheet risk. Now I will turn it over to Felix for a discussion about our continued deposit focus, commercial banking highlights, and the commercial variable versus fixed rate portfolio metrics.
Great, thank you, Jennifer. With all the focus on banks' liquidity in the market today, I want to spend a few minutes talking about our deposit portfolio. We have a very well-diversified deposit base consistent with traditional community banking. Our clients include small businesses, professional service firms, and nonprofit organizations. I'd like to highlight a few client segments that we have a particular focus on. Community benefit districts are neighborhood organizations common to San Francisco. These quasi-municipal organizations have very stable and recurring deposits derived from city-collected property tax assessments. We've developed a great network with these organizations and provide them with a full complement of cash management and deposit services. Political campaign, treasurer, consultant, and attorney accounts are another client base that we have an expertise in. These clients also require our full complement of cash management and deposit services and maintain significant deposit balances throughout the year. With the overlapping political cycles of local, state, and federal campaigns, seasonality of these deposits is limited. Other deposit clients include nonprofit organizations, labor unions, and homeowners associations. This next slide shows the composition of our deposit portfolio by account type. Now, as you can see, the largest portion of our deposits resides in our non-interest-bearing demand deposit accounts. 46% of our total deposits are in demand deposit accounts, which are typically our small business clients' operating accounts. The next largest account type is our money markets, which represents 27% of our total deposits. This is typically our clients' excess cash above what they need for their daily operating cash. CDs represent 20% of our deposits. Now, although this segment has grown somewhat as rates have increased, almost all of these are less than 12 months in duration. Our overall deposit cost of funds was 0.62% at year end. Our commercial banking loan portfolio is comprised primarily of small business and middle market clients located throughout the 9 Bay Area counties. As with most community banks, we focus on traditional C&I business, such as professional service firms, contractors, and food service businesses. We feel one of our competitive advantages is our ability to provide sophisticated credit structures to our small business clients. Our experienced relationship managers offer creative structures, combining both conventional and government guaranteed loan products to provide the most flexibility and options for our clients. We also provide a full suite of cash management products, online and mobile banking, and local client support for our clients. Our commercial loans represent 50% of the bank's total credit portfolio. And of this, 30% of our portfolio is commercial real estate and multifamily loans. These are comprised of our owner-occupied real estate loans to our small business C&I clients and small multifamily properties to our real estate investor clients. Approximately 15% of our portfolio is traditional C&I loans and lines of credit to our small business clients. And this includes our SBA 7A loans. The overall yield on our loan portfolio was 4.67% at year end. The next set of slides illustrate the fixed rate exposure in our loan portfolio. Our commercial loan portfolio is comprised of traditional community banking small business loans, such as lines of credit, term loans, and SBA 7A loans. 47% of these loans are variable rate loans. Another 30% are fixed rate loans, repricing or paying off within 3 years. Only 23% of these loans have a fixed rate longer than 3 years and are typically fully amortizing term loans. The yield on our C&I portfolio was 6.07% at year end. Our commercial real estate loan portfolio also has a limited amount of long-term interest rate exposure. Generally, our investor real estate loans are comprised of multifamily properties with 5-year fixed rate loans. Only 14% of this portfolio has a fixed rate longer than 5 years. The overall yield on this portfolio was 5.9% at year end. Now I'll pass it over to Jennifer to discuss the residential loan portfolio.
Thank you, Felix. I will touch briefly on our residential interest rate risk. The residential products in our portfolio are 3, 5, and 7-year ARMs predominantly, with the loans transitioning to a variable rate after the fixed period. While the loan terms are 30 years, our historical experience is a borrower will either refinance the loan at the end of the fixed rate at the current market rate, or the loan has already been repaid through the sale of the property. Loans transitioning to variable rates at the end of the ARM period is uncommon. As you can see, our interest rate risk, duration risk is longer in the residential portfolio compared to the commercial portfolio. However, these loans tend to have a lifespan of around 6 years, as this portfolio turns over faster than the typical 30-year fixed rate mortgage portfolio. Now I will turn it over to Ed for final closing comments and audience questions.
Great. Thank you, Jennifer. We're so pleased that you chose to join us today. are grateful for the opportunity to share some of our insights. If you'd like to schedule a meeting with our team in the future, just reach out to Leslie Catter, please, our bank's head of marketing and investor relations at leslie.catter@bankofsf.com. Now I'd like to open the floor to any questions that you may have, and our management team looks forward to responding.
Hey, that's great. If you want to stop screen sharing, Leslie, then we can. I'll be together. Excellent, great job. Yeah. So, can you give us some color? Oh, we do have some questions. But just to finish my thought, can you give us some color on how things are in downtown San Francisco? From a vibrancy. Maybe compare it to before COVID, and then when COVID first kind of paralyzed everything to how it is now.
Sure, and I'll start, and team, let's just pitch in on that one. Well, first in the pandemic, the neighborhoods thrived, I think, which was typical in many urban environments during the pandemic. San Francisco has a disproportionate share of its business in tech companies, and they probably had the most liberal work from home policies of any industry type. I believe only about 40% of the folks are back in the office on a regular basis now when you're looking at those key card index measurements. But folks are slowly coming back. And in our own bank's case, it just, our marketing resources are limited, so we don't spend much in advertising, but we do host a number of events in our office. So look forward to your meeting with us in the bank. You'll see that's where we host a lot of events for the nonprofit community that we serve. And also I wanted to comment, Felix mentioned what we do with the community benefit districts. In the city, there's 17 or 18 of those, including one here in the financial district. There's one in the South Financial District, Union Square, Fisherman's Wharf, Japantown. And these are organizations that address the immediate neighborhood's needs. And so in places like Union Square, it'll be for ambassadors, people giving directions, cleaning up the sidewalks, or if they're homeless folks and camped there, they'll just approach them and just say, hey, we've got resources to help you. You just can't stay here on the sidewalk, however, but we'll take good care of you. In other neighborhoods, residential neighborhoods, it's more beautification projects. So the city is slowly coming back. Class A office buildings are doing well. The ones that are most impacted, I would say, however, are the B and C properties over here. I know that Felix and Jennifer are two folks that commute in our regional transit system, BART. And Felix or Jennifer, if you could just weigh in on what your experience is, because that's a real-time measurement.
Yeah, I'll maybe start first. I think Ed pointed out that the office vacancies, or at least the folks coming into the office, still hasn't recovered. So that's had a little bit of an impact on the downtown retail, restaurants and things. They just haven't had the critical mass to get back to kind of pre-pandemic business. But kind of a leading indicator, I take the BART, which is our train, in every day when I come into the city, and it's packed more and more, particularly in the rush hour time. So, I think they'll probably start adding new trains soon. I think there definitely is a return to work and a return to the city. There's more events happening now. So the sales team, the marketing team, which reports to me, we're going to more and more events. We're hosting more and more events. So hopefully by summer, I think we'll get, somewhat back to normal. Tourism is starting to come back a little bit. The convention business really drives the downtown market, which hopefully that'll be a strong summer. So fortunately for us, we don't have a lot of concentration in downtown. We don't have a lot of concentration Class A office space or anything. So that the neighborhoods have been pretty resilient, and probably even a little bit of an uptick with so many people working from home over the last couple of years. But it's coming back. It is slow though. I bet it's trailing the rest of the country, I think, for sure.
Okay, so it's been improving and continues to improve, and it hasn't been any retrenching or anything. Okay, great. And
no retrenchment.
And I think the more people are coming in, especially the young people earlier stage of career, they're seeing the benefits of coming into the office and being together. So we've seen kind of an accelerated pace even within our own bank, with people coming in more often and feeling good about coming in.
Right, right, good. And so what have commercial real estate values in office in particular, how have those been trending in San Francisco and in around San Francisco?
Sure. The well, the Class A properties, as I mentioned earlier, just their occupancy is held up. It's the B and C commercial properties owned by, just individuals, family, mom and pop investors and all. They're very much focused on maintaining occupancy, and they've dropped rates significantly, and that has a direct impact on values. So no, residential and commercial values are down. We've adjusted, it was not just in the current year, we adjusted last year, just our maximum loan to values, both on residential and what we'll do on commercial, or if it's special purpose. And again, as Felix mentioned, ours is a classic community bank. We don't have any Class A office building that we're financing. And in the neighborhoods, in the central business district, we have one commercial real estate office loan, and that's about a $2 million loan on a property with a loan to value of under 10%. So even if there's a precipitous drop, we've got a very good equity cushion there. In the neighborhoods, where values have held up more, we've got 3 properties, one in the Mission District, one in Russian Hill, and the other Pack Heights. And so in aggregate, I believe it's $16 million we have in loans on those 3 properties. And but the LTV, the aggregate amounts 41% on that. So I think we all need to brace ourselves for just a tough commercial real estate market, and San Francisco is not alone in that one. It's a broader phenomena, but I think part of it is just staying true to what a community bank does. It's just major urban properties are not our cup of tea. Wendy, Felix, anything else further on the credit?
Yeah,
Wendy?
I mean, I just wanted to reiterate that an overwhelming majority of our commercial real estate is multifamily properties. Outside of downtown San Francisco, obviously. So those values have kind of held up primarily because there's really a lack of inventory and housing in the Bay Area. So those properties continue to perform. They're very resilient in the Bay Area, and that's kind of been our our sweet spot throughout our history. Is that's really where we operate on the commercial real estate piece. So although cap rates have changed because of interest rates, but we generally don't go high on leverage on those deals anyways, because they're all cash flow underwritten. So depending on what the market rents are is really going to drive how much leverage each property can have. So we're a little bit insulated from the office impact.
Right. Okay. And actually, one of the questions was, what loan to value are you originating loans at now?
Well, Ed mentioned, I'll answer this. Ed mentioned that we kind of brought our loan to value, maximum loan to value policies down, but really we weren't approaching those loan to value levels even when we're originating loans. It's really driven by cash flow. So in general, it's probably 60% or less on a multifamily property, and that's really depends on how well those rents are performing. So that's just in today's environment. Even when the market was going really great, we were probably in the mid-60s. So generally, we're not underwriting highly levered deals because we really rely on that sustained, stabilized cash flow to support it.
Right, and that was at origination, right?
Yeah.
Right. Okay. All right. And then another question was, without a government securities portfolio, it's rare to see a bank without any securities. So without a government securities portfolio, all of your earning assets are in loans. And so do you worry that your earning asset base is diversified enough?
For a bank of approximately 600 million in assets, no, we do like the diversification and also the interest rate risk characteristics. We mentioned a significant part of our overall portfolios are residential loans, but those are just almost exclusively 3, 5, 7, 1 arms. So that replaces relatively slowly, but also we collect a 1% fee on all of those loans. So if a loss the velocity increases, we actually do better as we can deploy. Well, first we'll be able to realize the unamortized fee income on that one and redeploy it at today's rates, which today's rates on residential would be in the 6 to 7% range. Overall, I think if you look at our entire bank, I believe about 60% of our loans will reprice in the next 12 months.
And
Go ahead,
and
Jen.
touch on just a little bit of the diversification aspect, and I know Felix will probably have some commentary on this as well, but when we look at our assets and what we're earning, we do take in consideration the mix of our loans and what kind of industries they're in, what type of products they're in. So we're looking at diversification within our loan portfolio. As a larger bank, when we have the ability to have an investment portfolio, yes, that will diversify our earning interest assets. But right now, we look at that diversification within the portfolio itself to make sure that we're not unduly concentrated in one area, like, we only do hedge funds and that's it, or we only do crypto, and everybody knows how that turned out. So we do take that consideration in our portfolio. Obviously, we have some concentrations just because we're in the Bay Area in general, but we do try and take care of that risk and evaluate it in our portfolio. And as we grow, we will be adding an investment portfolio, but it's just not there at this time, nor is it the time to do that. It's going to be a prudent, careful approach.
Okay, good. And so are you seeing, can you talk to us about your deposit flows, and are you getting any deposit flows in from the market dislocation with FRC, Silicon Valley?
Jennifer, do you want to cover that and I'll piggyback?
Yes. So obviously, with everything going on in the marketplace, we've been watching this very closely. We have seen some large deposits that have come out, but we've also seen some people diversify their overall deposits with multiple institutions. So it has gone both ways. We haven't seen a significant change overall. Overall, I would say we're trending up, but we do see on both sides of that for different risks profiles for those customers. So Ed, if you want to add anything else, nothing large going out, just to be very clear.
I'll add, sorry, Ed, I'll add like maybe a little bit of anecdotal detail. So, we don't have a lot of clients that had a mixed relationship with SVB as an example, just because it's a different client base. So we've had maybe a handful of clients that have moved some funds over to us from there for safety. But we do have a fair amount with First Republic that have a dual banking relationship. And we have been able to add a little bit or move a little bit more of our deposits over or their deposits over to us. A lot of that is, talking to our clients, explaining how we differ from some of those other institutions. And then really identifying, if their real concern is FDIC insurance, talking about different strategies and structures that can increase that for them. Or if they're just looking for, safety, yield, but it really has opened up more conversations. We haven't seen like the floodgates of dollars coming in, but we have actually moved some. So I think, and there's been, as Jennifer pointed out, there's been some customers that have just decided to diversify maybe into a brokerage account or something on excess cash. So we've seen a little bit both ways.
Yeah, and if we monitor all of our deposits, particularly close to our top 20. In our top 20, there is only one that had a significant withdrawal since all this market turmoil starting almost 3 weeks ago. But I think on balance, we've held our own. We're very pleased with that. And also, yes, we've tested our Fed funds lines and our Fed discount window, but all of those are unused at this point. The only utilization we have is under the Federal Home Loan Bank to support our municipal deposits. And so, the classic ones, the city and county of San Francisco and the state of California, I believe that's approximately 45 million. Today, the Federal Home Loan Bank letter credits either 105 or 110%, but we have no direct borrowings. So we have a little over 200 million in capacity there. Hopefully just we'll get more granularity over time. And there is opportunity, I think less with former Silicon Valley Bank clients, more with First Republic. First Republic was a highly respected competitor, and where we would go up against them would to a great extent would be in nonprofits, because both they and we just target nonprofits. And you know, we've gone back to our 17-year history, all those transactions where we came in second and all. So we're reconnecting with those folks as well. And so, yeah, there is opportunity there. But it's going to be a more granular base, I believe, going forward.
Okay.
Yeah.
Okay. And talk about the nonprofits. Are you seeing any changes in money flows going into nonprofits? Has that been changing? Has it been pulling back a bit given the environment?
Do you mean on their ability to fundraise, or just kind of where they're positioning their cash?
Well, I guess both, but I was thinking on the fundraising side.
Yeah, it's probably a little soon in the you know, kind of maybe the financial market disruption to see any kind of change there. A lot of the nonprofits that we work with, not all of them, but a lot of them have multi-year grant commitments, either with state, federal, or you know, estate planning. Some of our religious organizations have family gifts through an estate that has a multi-year pledge agreement. So we haven't seen a significant change in the amount of fundraising that they're able to do. The change that I've maybe seen a little bit is some of them have reassessed their bylaws on how much of their cash needs to be FDIC insured. So they've revisited that and have had more discussions with us. And should they increase that amount? Should they move some funds into different types of accounts to increase their FDIC insurance? And that's kind of what we've seen over the last 3+ weeks.
Yeah. No, thanks, Felix. That's a great explanation of what we do there. And I wish we were the bank of the San Francisco Opera and the ballet and the symphony. We're not. That's not who we are.
Not yet. Not yet.
Not yet. But we are the bank for so many of the social service organizations, community mental health, low-income housing, and a lot of that funding is coming from the city, the state, the federal government, and all. And I think that's recurring, sustainable, and the housing needs in California are not diminishing. And so, no, we are very, very active in this world, and maybe there will be some opportunity going forward. The banking landscape is going to change after what's happened with SVB and just the current situation with First Republic. And
Well, you're well positioned, right?
oh, we've
do
got the
think so.
capital.
Right, right. Well, very good. I think we're out of time, but I really appreciate you coming and updating us on the story, particularly with everything that's going on in your part of the world. So thank you.
No,
Thank
no,
you very much. Thank you.
we
Thank
appreciate that, and we appreciate the other 4 banks presenting too. Just you know, the California banking community is small, and just we got a number of friends on groups presenting today. So just very proud to be one of the 5. Thank you.
Thank you. Very good. We appreciate it.